Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to cover the economy show, and we're going to go through some key aspects of what's happening with fund flows, what are some of the high-frequency data points telling us with COVID, resurgence, what is happening in the U.S. economy, where are some struggles, what's happening in the European economy, and then finally wrapping up, we're going to look at food and Chinese trade flows just to see where are we against the U.S. trade deal, and shockingly not that close. So before we get into part one, just a reminder, now would be the time. Please subscribe, like, share, trying to keep this free and keep this moving about. So we appreciate your help. And then before we dive in, just a quick update, because we filmed the EIA show ahead of time. So now we actually have an update of the oil production out of the Gulf of Mexico. When we filmed, it was about a drop of about 915,000 barrels a day. It's up to about 1.23 million barrels a day. So again, just an additional drop. And then an interesting point, as we talked about in our Turkey show, when we looked at the rising debt in overall, the Middle Eastern countries, it's worth noting that Saudi Arabia just announced another decline and to a near-term low of dollars or FX reserves, which again is just an inherent pressure as we consider where are they going to sit, how much longer can they tolerate this, especially when we look at low prices and or volume, which is why we think that there's going to be an additional increase, just because at this point it's, do you push down price to increase refinery throughput, because then you give some margin back to the refiner and incentivize them to increase, which is going to be overall a problem. And now that's kind of an interesting segue, because this was something that came out looking at through 2019. And just to kind of piece apart, why does this matter? Because when we talk about FX reserves, a shortage of US dollars, when we look at international holdings, it's important to look at how much essentially foreigners have been buying U.S. equities. So when we look at U.S. corporate stock holdings, you can see it was growing from 65 till about 90, but then we had this huge acceleration from about 97 to today. And if we look at, well, how many gains have you had over the last how many years? And if you have a shortfall in dollars, what is the fastest way to do that than to sell some of your winners or pare back some of your equity holdings? And that's why when we look at some of these issues with foreign flows, the question is, okay, well, we've already seen China talking about selling about $200 billion worth of treasuries, which in our opinion is pulling forward dollars, about $200 billion worth. Well, what happens when people start selling equities? Like, is this something that we have to be concerned about as we get foreigners looking to liquidate because they're short dollars, and this is a cheap, quick way of, look, I can sell Apple here, I've made a huge gain, and it's time to take some off the table and pull some of these dollars and repatriate them back home. And this is going to be something, because it's obviously a massive percentage, and I would assume that based on what we've seen, 2020, we've only seen this increase, but the problem is just how much is it increased, and essentially can we see additional outflows, which is something that we think is not really appreciated in terms of some of these fund flows over time, because a lot of the growth in U.S. equity price, about 85% has come in the overnight or at low volume periods, where we have an algorithm that essentially kicks in with a VWAP at 11:15 and carries us through the end of the day. So the question is, do we start to see that reverse and we start to see some risk come off the table, not only ahead of a potentially contentious election, but also just to try to pull some of these dollars forward and shore up balance sheets on a go-forward level? So now when we pull that out a little bit and look at, okay, well, let's look at held in retirement and taxable accounts. And you can see that it's at an all-time high when we look at it from 2019. And the top 10th percentile of net worth owns about, I don't know, is it safe to say 95% of the stocks out there? So then the question is that as you have 401ks getting liquidated, where you have people retiring, start living off of some of this volume, some of this net worth, do we see an increase in total outflows, not only from a foreign perspective, but also in terms of some of these liquidations. Now, the benefit for some of this is a lot of it is targeted funds, where a lot of people will get lazy and say, well, you plan to retire and let's say, if I'm lucky, 2055, that puts me in a more aggressive, where as you get older, you shift from an equity exposure to a fixed income exposure. So as some of these people retire, you're going to see, again, it's more about, well, how much exposure is equity, how much exposure is fixed income, which is going to be kind of the dynamics as to where do we see some of this pressure. But again, just more pressure to the outflow side. Now, it was an interesting chart just because obviously we're talking about the economy, and we do a lot of focus on economic data points that we think are interesting or should be followed. And here you can see that we actually had the correlation to market and GDP. So you can see that right before the tech bubble bursting, you can see that we got to a pretty low correlation to GDP and the underlying market. And we're negative now. So we actually have a negative correlation to the economy and to the stock market. Now, again, given, like you can see, it's never one-to-one at all. But when people say that you can't buy a unit of GDP, that is inherently false. That is literally what governments do when they do stimulus. They're trying to buy GDP points, whether it be the consumer, government, investments, or exports minus imports. There are ways to try to increase overall GDP. And if you're increasing GDP, the consumer is going to be better. So retail sales are up. Companies will be investing more CapEx. That'll be benefit for investments, and that'll be good for returns and overall growth for the underlying stocks. Again, the precipitous drop is going to correct itself at some point, whether that be equity markets coming down, economic data getting better. It's probably a mixture of two, but it's going to come down to, again, fund flows. What are the fund flows doing? Because clearly there's been a big disconnect. There's been a huge amount of essentially volume in a VWAP level, which has been overall pressure. And then when we talk about overall pressure, we have to think about, well, what's happening in Germany? And we, Merkel just got the agreement to see the shift lower in terms of lockdowns, which is, again, going to put pressure on the overall economy, which is what we've been talking about since the last few weeks. And the shift down from, let's call it 85 to 80. And we think there's going to be additional pressure once this starts to filter through the system. And you'll see this pull back closer to 75 when we start to look at some of those high frequency data points, which is why when we look at, some of the stuff coming out right now, where we have Doba exports are decreasing, but again, Libyan exports are increasing, which is going to be a pressure because Europe isn't buying as much. And then as we continue to see a record amount of Norway export loadings expectations, with the North Sea firing up with about 22 cargoes, essentially 22 cargoes are expected, which is back to the highest since the new field turned on in October of 2019. Again, putting more crude into a market, into a struggling European economy. Now, these look familiar. There's nothing new here in terms of kind of what we're talking about. But this is just looking at where things sit right now on economic activity versus the spread of coronavirus. So this is as of October 19th, and things have gotten worse since October 19th as we go into October 29th. So we expect to see the German, French, Spanish, Italian, UK. We expect those to see those solid bubbles, which is the solid circle being the most recent. Those are going to be down and to the right because we're going to see pressure on the underlying economy, but also an increase in total COVID cases, which is why that's going to have a negative correlation and move. The U.S., as we were going to go through some of the economic data, it remains fairly consistent. Some good spots, some bad spots. But on an overall aggregate, there's nothing to say we should move lower. It's something where we think we going to continue to move sideways in terms of daily activity. But we also think that, based on the data we're seeing, there's an increase in cases, so that'll shift to the right. But we don't think there's going to be a huge drop down in just total activity as Japan kind of holds steady, even though their activity has slowed a little bit. So we'll see a little bit of a normalization, but to the downside. But again, so far their coronavirus has been fairly consistent, and there's no reason to see those increasing right now. The bigger one, obviously India. India has seen a nice resurgence in terms of total activity. And on a festival side, obviously the festival season, it's ramping up in a big way, which is going to be an overall positive for activity. And that's already reflected in here. There's right at this point, we think it's going to hold at this level. There's not much to say it goes up or down. The question is going to be on the other side of this: is there a resurgence in COVID as people get together for for festivals and getting together? Russia's the one where we're gonna see a bigger slowdown in just the total aggregate, not only in cases, which is going to move it to the right, but also in terms of just total economic activity, which is going to pull that down, which again is just going to be a problem for just overall European demand. Which if Russia isn't consuming as much, it just puts more crude, more product into the water, and it would just be an inherent overhang. Looking at just the cumulative growth, because one of the things that we've been very consistent on is that we were bearish the global economy starting in 2019. So when we look at what this was in terms of the expectations in January of 2020, we weren't alone. There was a view of cumulative growth from 2013 to 2018, and then what the expectations were as we came into 2020. There was already an expectation of some slowdown in developed markets, but we became more concerned in emerging markets and low-income countries, which kind of shook off what was expected. And it was just because we saw some cracks forming, and the developed markets would really bleed down to the emerging markets, and we saw additional pressure with U.S. dollar increasing, global trade slowing, which was going to put some additional pressure there. But as we go into October, you can see that the numbers have gotten much worse, specifically in developed markets, but also in emerging market and low-income countries. Last week, sometimes you're proud of some things. You think that some segments could have been better. I thought the poverty one was very good, and it's very timely and consistent with what we've been saying with food inflation, food pricing pressure, and just an increase in overall poverty, which is going to put additional downward headwinds on the emerging market and low-income countries, which is why we think that there's going to be that cumulative growth is just going to struggle as we go forward, not only through 2021, but also well into 2025, which is why we continue to be just looking at data points to see, are we wrong? Is there some place that it's brighter than others? But right now, things continue to trend kind of in our favor, which is unfortunate just because we continue to be relatively bearish the overall economy and just not only Q4, but what 2021 actually looks like. Now, looking at some of the activity bounces, looking at the monthly activity, again, this is through August, and we've already talked about through October, but you can see that there's been a fairly consistent move in some of these Latin American countries, where some of them are starting to get a little bit worse, but again, it's just this consistency of just kind of going sideways with Brazil has gotten a little bit worse. Argentina continues to struggle, but we've seen Mexico, Colombia, some of these areas get a little bit better. Chile has issues, obviously, with their copper production, with rolling strikes and some pressures in terms of what is going to happen overall. And this is just going to be kind of consistent where, again, we're not seeing that real resurgence back to the overall levels, especially when you consider that this goes back to August 2018. And this is why we continue to look at it. We saw some softness coming into the market as you look at, when we talk about starting to get bearish in July of 2019, you can see that in August of 2019, there was this pressure to the downside that continued to kind of eat through some of these, bigger countries. And this was, again, part of why we were starting to get a little hesitant in terms of where the market was going to go overall. And now when we look at just what's happening on the aggregate level. Here you can see the stocking up in the pandemic. And we saw that obviously everyone stocked up as we went through March, April, May, June, July. And we started to see some semblance of normalcy as we got through July. And again, that's when we talk about inventories normalizing. People, they essentially worked through all the stuff that was in their basement or garage. And now we're starting to see a little bit of an uptick of additional sold out packages. But companies also don't want to miss out on a renewed resurgence of hoarding or some additional purchases. And again, that ties back to the EIA show when we talk about how trucking remains strong. And this is kind of showing why we think it's going to remain strong, where guys are trying to make sure that the shelves aren't empty, that everything is constantly restacked, because you don't want to leave money on the table. And when you have an empty shelf and someone goes to look for buying your product and it's not there, that's money, because then they'll either buy a supplement, they'll buy something maybe a little bit more expensive, a little bit cheaper. But again, you're missing out. So the idea is trying to maintain some of this inventory to make sure that everyone's kind of consistent with where things are going. And now just to wrap up this segment, we just want to look at the number of U.S. small businesses that have dropped off. And you can see that we maintain this down 25%. And we've shown this in so many different ways. We've shown this through hours worked and just total flow. And this is just another way to show that there remains a very a big reduction in just total economic activity on the U.S. small business side, and that's not really getting made up anywhere in the market. And this is something where if you look, there's been really no uptick overall and it's something that we think is actually going to accelerate as the PPP loans come due. As stimulus becomes, well, does it come after the election now? If it comes after the election, how far after the election? And this is just going to put those downward movements in just total business activity, which is going to be a problem. And we'll talk about this a bit more as we go into segment 2, where we look at different Fed data points and what this means on just an aggregate for U.S. total activity as a whole.